All right, let's talk about Cal-Maine Foods. This one is a real head-scratcher. They report an earnings beat, and what happens? The stock tanks. So in this explainer, we're going to dig in and figure out what exactly spooked the market here. Why did that good news completely fall flat?
Right, so this is the big question of the day. You've got an earnings beat, so why the crazy 8% price reversal? The stock shoots up in the pre-market, everyone's feeling good, and then boom, a complete reversal. It sells off hard, a huge swing from the high to the low. So what on earth happened? How did that optimism just vanish?
Okay, the confusion really starts right here when you look at the headline numbers. I mean, check this out. On the bottom line, their earnings per share, a solid beat, $2.13 versus the $1.95 Wall Street was expecting. Awesome, right? But then you look at the top line, the revenue, and it's a miss. Just under $770 million when folks were looking for closer to $800. It's a classic split decision, and that's our very first clue that there's a much deeper story here.
And this chart, wow, it just paints the picture of the chaos, doesn't it? You can see the stock just rocketed up, almost 5% in the pre-market. That's the knee-jerk reaction to the earnings beat. But then it's like the market had a second cup of coffee, read the fine print, and completely changed its mind. The stock reverses course and ends up dropping more than 3% below where it started. This is what we call a sentiment reversal, and it's a powerful one.
Okay, so let's get into it. This headline really was a confusing print.
You know, the story behind these numbers is really a conflict. It's a battle between two really powerful opposing forces. You've got the tough reality of the market they're in, and then you have the company's own game plan. And honestly, how you feel about this stock really comes down to which of those two forces you think is going to win.
And that brings us to the central theme here. Cycle versus strategy. Let's dig into that.
So this table really lays out the tug of war. On one side, you have the cyclical headwinds. I mean, look at this. Revenue down 19% year over year, earnings down over 50%. That's because egg prices are just coming back down to earth from those crazy highs. That's the cycle part of the story, and it looks pretty rough. But then you look at the other side, the strategy part. They still beat earnings expectations. Their shift in what they sell is protecting their profit margins. And get this, they have over $1 billion in cash and zero debt. It's a fortress. So you can see why the market was so conflicted. It loved the EPS beat, but hated the cyclical story.
And this is the strategy in action. This is the proof. Look at this shift in their portfolio. The slice of their sales coming from the good stuff, specialty eggs and prepared foods, jumped from about 31% last year to over 46% this year. That is a huge move. This is exactly why their profits held up so well even when regular egg prices were tanking. They are literally trying to escape the commodity trap, and you can see it working right here.
Okay, so what's management's playbook in all this? Let's take a look. I think the CEO, Sherman Miller, really nailed it on the call. He said, "We're building a business with strong base returns and multiple growth engines." And that's it right there. That's the whole game plan. It's not just about getting through the tough times. It's about building a fundamentally different, stronger company for the long haul. And this is how they're going to do it. It's a three-part plan. First, they're investing big to expand that prepared foods business. Second, they're pushing to get those specialty eggs to be more than half of their sales. And third, they're using that amazing balance sheet to reward shareholders. I mean, they bought back almost $75 million in stock this quarter. It's a really clear focused plan.
The earnings call Q&A was super important too. Management didn't sugarcoat things. They said the bird flu risk, HPAI, is definitely not behind us. They also warned everyone, hey, this expansion is going to cause some short-term pain. Expect lower volumes and higher costs for a bit. But on the flip side, they're targeting some serious growth, like 9 to 10% a year for that prepared food segment. And they kept hammering this point home. This is a long-term story, not a quick trade.
All right, so where do we go from here? This is the next call, our view.
Okay, so here's our prediction. That pressure on revenue, it's probably going to stick around for a bit as egg prices stay normal. So what's going to move the stock price? It's all about execution. The market is going to need to see that this expansion into prepared foods is actually working. The biggest risk? Another bird flu outbreak, or if they stumble on these big expansion projects. So for now, the stock is pretty much stuck in this battle between its old cyclical self and its new strategic potential. So putting it all together, our rating is market perform. Look, the long-term strategy is absolutely compelling, but you just can't ignore the short-term headwinds and the risks. We think the stock price right now is pretty fairly balanced between those two stories.
All right, let's have a little fun for our last segment. Let's put on our trader hat and talk about a trade idea.
So the whole idea here is pretty simple. The market is laser-focused on the short-term cycle.
It's not giving the company enough credit for its long-term strategy. And for an investor with a bit more patience, well, that can create an opportunity.
So how could you play this? Well, here's a plausible structure. With all this uncertainty, options prices are high. So you could think about selling some short-term puts. Basically, you collect a nice chunk of cash now from all that fear in the market. Then you take that cash, the kicker, and use it to help buy some longer-term calls, maybe 12 or 18 months out. The goal? You're essentially using the market's current anxiety to finance a bet that the strategy story wins out over the cycle story by, say, fiscal 2027.
And of course, please remember, this is not financial advice.